Good afternoon and welcome to this webcast introducing the new lease accounting standard IFRS 16, which has been published today by the IASB. I'm Patrina Buchanan and I'm joined today by my colleagues Catherine Donkersley and Roberta Ravelli. Before we get into the webcast, just a few words on the information that you can find on the IASB's website today regarding IFRS 16. First of all, IFRS 16 itself is available for IFRS subscribers. In addition, on our website and available to all is firstly a project summary and feedback statement. This document discusses the requirements of IFRS 16 at a high level and explains how the IASB has responded to the most significant feedback received throughout the project. Secondly, you'll find an effects analysis, which discusses the likely costs and benefits of IFRS 16 and also, for example, includes quite some detail on the companies, industries and regions that are expected to be most affected by the new standard. So moving on to the webcast then, just a few comments about how this will run. First, if you'd like to download the slide pack, then there's a button to do that right below the window on your screen that's showing the slides. In the second half of this session, we'll be taking questions. So if you have a question you'd like to submit, then there's a text box on your screen to do that. Just type your question and click on Submit, and it will come through to us. A recording of the webcast will be available after we finished, and there's a link to where you can access that recording on slide 2. And finally, just to note that, as always, the views expressed during this webcast are those of myself and the other presenters. They are not necessarily the views of the IASB or the IFRS Foundation. And so with that, I'll hand over to Catherine to introduce IFRS 16.
Thanks, Patrina. So we'll start this afternoon with an overview of why the IASB made the decision to change lessee accounting. We've talked about this in quite some detail in our project updates over the last year, so I'll plan to keep this part quite brief. We'll then spend a few slides summarising what has changed in IFRS 16 compared to previous accounting under IAS 17. We'll concentrate on the biggest changes, most notably those to the primary financial statements of lessees. We'll also talk about the effect of IFRS 16 on a lessee's performance metrics. Finally, we'll talk briefly about the effective date of IFRS 16 and about the transition requirements. We're planning to talk through the slide pack for no longer than about 20 minutes to leave plenty of time for questions at the end. Starting with slide 4 then, which summarises why the IASB think it's necessary to change lessee accounting. So the IASB believes that leases provide an important source of financing and that lessees obtain assets and incur liabilities when they enter into leases. That's a view that's shared by a lot of the people that provided feedback to us throughout the course of the project. Most investors and analysts told us that, in their view, leases create debt-like obligations for a lessee. Contrary to that, though, most leases are off balance sheet today under IAS 17. Throughout the project, we've performed research about the problems that exist today in lease accounting and about the financial effect of those problems. There's a lot of detail about that research in the effects analysis that Patrina mentioned earlier and which is now available on our website. One of the things we found was that over 85% by value of today's lease liabilities are not reported on company balance sheets because they're classified as operating leases. So that means that a significant amount of the debt-like liabilities that investors consider to be created by leases are currently missing from company balance sheets. Because of this, investors and analysts face several difficulties today when they try to understand information reported by lessees. First of all, they struggle to get an accurate picture of lease assets and liabilities because those amounts do not appear on the balance sheet for operating leases. Secondly, they find it difficult to compare companies that lease assets with those that buy similar assets. And again, that's mainly because assets and liabilities arising from today's operating leases do not appear on the balance sheet. Finally, investors and analysts don't have enough information today to reasonably estimate the amount of off-balance sheet lease obligations. We understand that some investors currently make rough estimates, and in many of these cases, they're actually overestimating the amount of lease obligations that exist today. Because of these problems with information reported about leases under IAS 17, the IASB decided to make a number of changes to lessee accounting, and these are summarised on slide 5. First, I should mention that IFRS 16 substantially retains the existing accounting requirements for lessors. That's because the feedback we've had demonstrates that the costs of making any substantial change to lessor accounting would outweigh the benefits at the moment. The same is not true, however, for lessee accounting, where the IASB has concluded that addressing the problems with today's reporting is worth the cost of making those changes. Therefore, IFRS 16 requires a lessee to bring all leases onto the balance sheet, with a couple of limited exceptions. In other words, lessees will now be required to account for all of their leases, similarly to today's finance leases. We'll talk about the effect of this on the financial statements over the next few slides. In summary though, bringing all leases onto the balance sheet is intended to address the difficulties faced by users of financial statements today. It will do that by ensuring companies include properly measured financial liabilities for all leases, thereby addressing concerns that exist today about leverage information. Recognition of lease assets on the balance sheet will enable investors and analysts to compare companies that lease assets with those that purchase similar assets. The other primary financial statements will also be affected by IFRS 16. Now that assets and liabilities are to be recognised for all leases, rental costs previously recognised for operating leases under IAS 17 will effectively be replaced by depreciation on the leased asset and interest on the lease liability. Compared to reporting under IAS 17, this will affect both the income statement and the cash flow statement by increasing financing costs and cash flows and by decreasing operating expenses and cash flows. So I'll now hand over to you, Roberta, for a bit more detail about the effects of IFRS 16 on the primary financial statements.
Thank you, Catherine. First, I will talk about the balance sheet, which is covered on slides 6 and 7. Slide 6 summarizes what is included in the recognition and measurement of lease liabilities, and slide 7 summarizes what is excluded. Just to note also that the measurement of lease assets is based on the measurement of the lease liability, with a few adjustments where relevant. The general principle applied under IFRS 16 is that the amount of the lease liability should reflect those payments that are economically unavoidable for the lessee. This means that several sorts of payments are included in the lease liability. Firstly, all fixed payments are included. Fixed payments are all those that are unavoidable by the lessee. These include, for example, any inflation-linked payments, because these are unavoidable and do not depend on any future activity of the lessee. Secondly, the lease liability also includes any optional payments if the lessee is reasonably certain to make these payments. This might include payments related to extension or termination options, or termination penalties if the lease term reflects an option to terminate the lease. The reasonably certain threshold in IFRS 16 is the same as that used in IAS 17 today. And finally, the lease liability also includes amounts expected to be paid under residual value guarantees. Again, this is because these payments cannot be avoided by a lessee. Moving to slide 7, in terms of what is not included on the balance sheet. First, IFRS 16 includes two optional recognition exemptions relating to leases of less than 12 months and leases for which the underlying asset is of low value. The ISP decided to include these exemptions because for these leases, the ISP didn't think that the benefit of recognizing assets and liabilities on the balance sheet outweighed the cost of including them. This is essentially because entities often have very high volumes of these leases, but the assets and liabilities arising from them are often immaterial. In addition, the lease liability does not include the variable lease payments linked to future use of the lease asset or to sales arising from the use of the lease asset. This is partially for cost-benefit reasons, but also because many consider these payments to be avoidable by the lessee. This is similar to IFRS 17 today, where contingent rentals are not included in the minimum lease payments. And finally, the lease liability also excludes any optional payments that a lessee is not reasonably certain to make. Again, this is the same threshold as is used today in IFRS 17. Moving on to a lessee's income statement. As Catherine mentioned earlier, IFRS 16 will result in a decrease in operating expenses and in an increase in finance cost. This is because the previous rental expenses for operating leases will now be replaced by a depreciation charge on the lease asset and interest on the lease liability. Consistent with the interest charge on other financial liabilities, interest relating to a lease will decrease over the life of the lease as lease payments are made. Depreciation charges will be recognized similarly to those on other non-current assets and will typically be recognized on a straight-line basis. This means that for an individual lease, the overall income statement expense will be higher in the early years of a lease and lower in the later years. This is different to today's operating leases, for which rent is generally recognized on a straight-line basis. However, as we describe in detail in the effect analysis that we published today, the net effect of IFRS 16 on the income statement is expected to be minimal for many lessees that have a portfolio of leases starting and ending in different reporting periods. Slide 9 summarizes the effect of IFRS 16 for lessees on some key ratios that are often used by analysts to analyze performance. Firstly, IFRS 16 will give rise to an increase in leverage for all entities that have operating leases today. This is because of the recognition of lease liabilities on the balance sheet, which weren't there before. And similarly, these entities will also see a decrease in asset turnover ratios because assets relating to former operating leases will be recognized on the balance sheet for the first time. Applying IFRS 16 will mean that these ratios become much more comparable between entities that lease assets and entities that purchase similar assets. IFRS 16 will also affect profit measures. Most notably, profit measures such as operating profit, EBIT, and EBITDA will be higher under IFRS 16. This is because the interest previously embedded in operating rental expenses will become finance cost under the new requirements. The last thing we are going to cover before moving on to questions is the effective date and the transition requirements for IFRS 16. Catherine, could you please summarize for us?
Yes, of course. So we've summarised these topics on slide 10, where you can see that the effective date of IFRS 16 will be the 1st of January 2019. That means that entities will be required to apply the new standard to annual periods beginning on or after that date. Early application is permitted, but only for those entities that also apply the new revenue standard, IFRS 15. And that's because there's quite a lot of interaction between leases and revenue, particularly in areas such as sale and leaseback transactions. So it would be difficult to apply some of the new leases requirements without also applying IFRS 15. Moving on to transition then, the IASB took a fairly pragmatic approach here after listening to a lot of feedback from preparers about the challenges they expect when first implementing IFRS 16. Entities are permitted to perform a fully retrospective transition approach if they want to, but IFRS 16 also permits an entity to choose to apply a cumulative catch-up transition method, which is similar in principle to that permitted on initial application of IFRS 15. If an entity does elect this option, then there's a number of pretty significant transition reliefs. Most notably, such an entity would not need to restate any of its comparative figures in the year of initial application, and it would also not need to apply IFRS 16 to any leases that end within 12 months. The cumulative catch-up method also permits a simplified measurement approach for lease assets on transition, which is expected to provide a lot of relief for entities with high volumes of leases. The IASB concluded that the cost-benefit for preparers of permitting these reliefs justified their financial reporting consequences in the year of initial application. However, the transition requirements in IFRS 16 do include some extra disclosure requirements to help explain the effect on the financial statements of an entity applying the cumulative catch-up method. Finally, slide 11 provides links to some sources of further information relating to IFRS 16. The slide includes a link to the effects analysis, which we've referred to a few times this afternoon.